Good afternoon, everyone. I am Nisha Chaudhary from the Institute of Company Secretaries of India. Today, I welcome you all to the 23rd session of EEE 4.0 Master Knowledge Series of the Institute of Company Secretaries of India. The topic for today's session is FEMA, Reporting and Documentation Aspects. I would like to give you a brief introduction of the topic. The Foreign Exchange Management Act, FEMA, enacted in 1999 in India, regulates foreign exchange transactions and aims to facilitate external trade and payments while ensuring the orderly development and maintenance of the foreign exchange market in India. Reporting and documentation under FEMA are essential for compliance, monitoring, facilitating foreign exchange activities as it aims to maintain transparency in foreign exchange transactions, ensure compliance with regulations, and prevent illegal activities such as money laundering. By adhering to FEMA reporting and documentation requirements, entities can ensure compliance, promote transparency in foreign exchange activities, and contribute to the stability of foreign exchange market in India. To delve deeper into the regulatory framework of Foreign Exchange Management Act 1999 and to gain more insight of reporting and documentation aspects, we have with us CS Sunil Nanal, practicing company secretary. It's my proud privilege to read his brief profile before all our learning numbers. He is Commerce Postgraduate, fellow member of the Indian Institute of Company Secretaries of India, an insolvency resolution professional, and partner Kanj and Company, LLP, Company Secretaries. He is serving as Non-Executive Director, Tire Site Private Limited, Non-Executive Director, Giava Foundation. He has professional experience of more than 2 decades and was conferred Pandit Nehru Centenary Award for securing highest mark in subject corporate law and practice too. His areas of practice are company law, foreign exchange laws, foreign contribution and regulation act, insolvency and bankruptcy laws, foreign trade policies, EOU, SEZ, and STPI related matters. He is also involved in various other corporate laws related matters, domestic as well as cross-border transactions, merger and acquisition of companies in India as well as abroad, setting up companies' special purpose vehicle abroad. It is our proud privilege to have him as speaker for today's session and get benefited from his words of wisdom in the interesting yet technical area of FEMA. Now we welcome him at the 23rd session of EEE 4.0 Master Knowledge Series and hope to have enthusiastic learning. All the participants are requested to post their queries in the link provided for posting queries.
Thank you, Nishaji, for kind introduction. And I would like to thank our Mother Institute for giving me this opportunity again to present my views on this very important topic. And considering the vastness of the topic, and we have 2 hours in hand, what I've done is I'm focusing on 3 major pillars of Foreign Exchange Management Act from reporting point of view. One is the overseas investment, second is external commercial borrowing, and third is our foreign direct investment. So can I share my screen now?
Yes, sir.
Yeah. Is it visible now, clear?
Yes, sir, it is visible.
Okay. Yes. So good afternoon, everyone, and thank you for joining this very important topic for discussion. As mentioned by Nishaji, you can write down your questions, whatever query you have with respect to FEMA. I would like to answer them appropriately in the last half an hour or 15 minutes. For first 90 minutes, we will deliberate on, as I said, these 6 important topics from reporting and regulatory point of view. So as the topic suggests, we are going to discuss on FEMA documentation and reporting aspects of these important topics. So today we are going to cover overseas direct investments, employee stock option plan and ESPS of foreign entities issued to person resident in India, what all compliance are required to be done. Then from external commercial borrowings point of view, what are the one-time event-based compliances and what are the annual compliances. From foreign direct investment, downstream investment, and ESOP to non-residents. So we are going to cover these topics in today's 2-hour session. And in case participants have any other query under FEMA, they are free to post that. I will answer them at the end of the session. So we'll start with the topic overseas investment, and then I'll cover ECB, and then we'll go to FDI. Because what I thought is most of us are handling FCGPR and FCTRS related reporting compliances and filing FLA returns. So from practical aspects point of view, most of us are aware of the issues involved in that. But overseas investment, ECB, that's why I am giving more weightage to this, and we'll discuss and deliberate on this topic first. And the last session will be on FDI and downstream investment. So with respect to overseas investments, as all of you are aware, that a new regulatory framework with respect to overseas investment has been introduced from 22nd August 2022. And if one has to understand this topic in totality, you will have to refer to Foreign Exchange Management Overseas Investment Rules 2022, which are OI rules issued by Department of External Affairs, Ministry of Finance and Central Government. Then under that, under FEMA, there is Foreign Exchange Management Overseas Investment Regulations 2022 issued by the Reserve Bank of India, which talk about all the reporting requirements with respect to overseas investment. Then there are Foreign Exchange Management Overseas Investment Directions issued by Reserve Bank of India. And one more topic is there in case there is a cross-border merger, then Foreign Exchange Management Cross-Border Merger Regulations 2018. So if one has to understand the topic with respect to foreign overseas investment, we'll have to refer to these rules and regulations and the direction issued by RBI, which combines all the relevant provisions with respect to this topic. Prior to introduction of Foreign Exchange Management 2022 Overseas Investment Rules 2022, those were governed by earlier overseas direct investment rules, and a lot of changes have been made from 2022 onwards. We will see from the reporting point of view what all those changes are. So just before going to reporting, just to briefly touch upon what are the basic requirements of overseas investment rules and who can invest outside India, up to what limit one can invest outside India. So the OI rules says an Indian entity can make investment, overseas investment, up to 400% of its net worth as per the last audited balance sheet. And so who is Indian entity? That has been defined. So Indian entity means a company incorporated under Companies Act, or a limited liability partnership incorporated under LLP Act, or a registered partnership firm. So these are the Indian entities who are eligible to make overseas investment. And in addition to this, resident individuals are also allowed to make overseas investment within the limits prescribed under liberalized remittance scheme. So if an entity is investing outside India, that is a company or LLP or a registered partnership firm, for that entity, the maximum cap up to which it can invest outside India is 400% of its net worth as per the last audited balance sheet. And if the investor is a resident individual, then that individual can invest outside India within the overall limit of $250,000, which is given under liberalized remittance scheme. So if that person has already spent money on other eligible current account and capital account transactions, then those will be deducted, and only balance amount will be eligible to invest under LRS scheme. But yes, an individual also can set up a company outside India and can make overseas investment outside India. In OI 2022, the important change was made with respect to the how to arrive at the net worth. So it says the maximum overseas investment can be done up to 400% of the net worth as per the last audited balance sheet. And the guideline says the last audited balance sheet shall not be older than 18 months at the time of making overseas investment. So whenever an Indian entity is making overseas investment, it has to find out which is the last audited balance sheet available. And based on the last audited balance sheet, a net worth is calculated, and 400% of that is the maximum cap within which the overseas investment can be made. So many a times what happens is, suppose if a company has incurred loss as of 31st March 2024, and now thereafter a major capitalization has been done, shares have been issued, and that loss has been recouped by issue of additional shares, and now the company has got positive net worth. So if you go by the last audited balance sheet as of 31st March 2024, and if there is a negative net worth, then certainly that entity is not eligible to invest under automatic route, because the 400% of negative there will not be any amount eligible who is remitted outside India under OI rules. So in that case, if such corporate action has happened and if capitalization has been done and now the net worth has become positive, a special purpose audit can be carried out as of a cutoff date. Let's say if the capitalization was done in August 2024, cutoff balance sheet of 30th September can be drawn, and it can be for the special purpose audit can be carried out. And based on that audited balance sheet with the special purpose audit report, the entity can approach authorized dealer for making overseas investment. But what we need to keep in mind is whatever remittances, financial commitment is being made by an Indian entity, that should be within the limits of 400% of the net worth arrived based on the last audited balance sheet. Now, when we say foreign financial commitment, that includes equity capital. That means if the Indian entity is investing into the shares of an overseas entity, and RBI has also clarified that if an Indian entity is investing into compulsory convertible preference shares, that also be treated as equity capital. This is one form of financial commitment. Then other forms of financial commitments are loan, corporate guarantee, and performance guarantee. So if an Indian entity is giving loan to its joint venture outside India or to its wholly owned subsidiary outside India, then that is treated as a financial commitment. If Indian entity is issuing a corporate guarantee for any purpose, like if the overseas subsidiary is raising finance from local bank outside India, and for that purpose, Indian entity is giving corporate guarantee. So that is also treated as a financial commitment. A performance guarantee means suppose overseas entity has received certain orders, and for receiving that order or for filing a tender, it is required to give a performance guarantee by its parent company in India. So in that case, if Indian entity gives any such performance, then also it is treated as a financial commitment. The only difference in case of a performance guarantee is that whatever amount of performance guarantee is given, 50% of that is treated as a financial commitment. And in case of other form of financial commitment like equity capital, loan, or corporate guarantee, whatever amount is being remitted or guarantee amount is mentioned in the document, 100% is treated as, let's say 1 crore is invested as equity capital, that entire 1 crore will be treated as financial commitment. But in case of a performance guarantee, if 1 crore worth rupees performance guarantee is given, only 50 lakh of that will be treated as financial commitment, and accordingly, the total financial commitment given by the Indian entity is calculated. And what one has to ensure that this total financial commitment given by an Indian entity is within the limits of 400% of its net worth as per the last audited balance sheet. And then further, RBI has clarified that financial commitment does not include capitalization of retained earnings by the foreign entity. That means if a foreign entity has issued a bonus shares out of the profits earned by the foreign entity to the Indian entity, so there is issue of additional shares. So even though additional shares are being issued, because this is a capitalization of retained earnings, that will not be added into the financial commitment amount. So what should be considered while calculating financial commitment? It is only the actual remittance which is happening from India, or if it is in the form of guarantee, and if the guarantee is a corporate guarantee for any loan raised by a foreign entity outside India, 100% amount of the that corporate guarantee, or if it is a performance guarantee, 50% of that amount. So all this put together, all this financial commitment cannot exceed 400% of the net worth. Then, with respect to funding by way of debt and guarantee, the OI rules clearly provides that any Indian entity can provide debt or guarantee only if Indian entity has control. That means it has got more than 10% stake in an overseas entity. So if Indian entity has no stake in overseas entity, Indian entity cannot provide loan to any person resident outside India or cannot provide guarantee to any person resident outside India. And one important change which has been done in OI rules 2022 is earlier for giving loan, no documentation was required as such. So Indian entities were allowed to give loan without any documentation to its wholly owned subsidiary or to joint venture abroad. But now OI rules prescribe that the loan should be duly backed by a loan agreement. So whenever such reporting is done at the time of giving a loan, it is required to be backed by a proper loan agreement. That loan agreement is required to be properly stamped, and the necessary stamp duty is required to be paid on that loan agreement. And another important aspect, which was not earlier provided under FEMA, earlier ODI rules, that interest should be charged on an arm's length basis. So now no interest-free loan can be provided by an Indian entity to overseas entity. For companies, it was already taken care under Section 186 of the Companies Act, where Section 186 mandates charging of interest for the loan given to the other entities or to subsidiaries or wholly owned subsidiaries. But under FEMA, it was not a mandatory requirement as such. But in OI Rules 2022, now it has been made mandatory. So if there is any loan has been given, what we need to ensure is that what we need to first see whether Indian entity has control. That means either it has got control by way of management control over that entity, or it has got equity stake in excess of 10% in that overseas entity. Similarly, a guarantee also can be given only if the Indian entity has got control on the overseas entity. And guarantee can be in the form of corporate guarantee, personal guarantee, and bank guarantee backed by corporate guarantee or collateral by Indian entity or group company. So now, whenever Indian entity makes overseas investments, which is treated as overseas direct investment, as far as the reporting obligation is concerned, first and foremost, Indian entity is required to file Form FC, which was earlier Form ODI, to the authorized dealer, which provides all the information with respect to the Indian entity, which is making the overseas investment. So to Form FC Part A, we need to provide all the information of the Indian entity. So what is the name, address, contact person of the person in charge, and then what is the net worth of the company. So entire details are required in Part A. Then in Part B of Form FC, all the details of the overseas entity are required to be provided with respect to its name, address, business activity, what is the financial year of the overseas entity, what is the existing shareholding pattern and the proposed shareholding pattern of the overseas entity. So all that information is required to be given. So under OI rules, first and foremost, a reporting requirement is whenever an Indian entity is making any overseas investment, a Form FC is first required to be filed with the authorized dealer. And once that Form FC is filed along with all the required documents, that means it requires a fair value certificate if investment is done by a chartered accountant, or overseas CPA if investment is done in existing company. Then it requires to provide memorandum articles of Indian company, memorandum articles or legal charter of the overseas company. So whole list of documents are there which are required to be filed along with Form MC, and the documents are filed to the authorized dealer, and authorized dealer scrutinizes those forms, Form FC, and forwards that to ODI division of Reserve Bank of India. And once RBI processes the form, a unique identification number is issued. And now the important change which has been made is earlier, the first remittance RBI was allowing without getting UIN, and the first remittance was allowed to be made based on the documents submitted to the authorized dealer and by filing Form A2 and other documents or old Form ODI. But now under new OI rules, unless and until unique identification number is generated, no remittance is allowed. So whenever an Indian entity wants to set up a company abroad or wants to make an overseas investment abroad, the first step, a reporting requirement which it has to do is the Indian entity is required to file Form FC along with all the requirement documents to the authorized dealer. And once one authorized dealer is chosen to file the Form AD, to file Form FC, and a UIN is obtained, in case the Indian entity wants to change the authorized dealer, then no objection of the earlier AD is required, then only the AD can be changed. All further reporting is required to be done only through one AD only. So if suppose the first form FC is filed with HDFC, and the Indian entity wants to make further remittances in the form of capital or loan or guarantee, then all further form FC are required to be reported, and remittance also can be done only from HDFC Bank only. And authorized dealer, if Indian entity wants to change the authorized dealer, then prior approval of earlier NOC of earlier AD is required to change the AD, and then only the file can be moved from one bank to another bank. Once that form FC is filed, unique identification number is generated, and the remittance is made. So first remittance can be only in the form of equity capital. As we discussed in the earlier slide, an Indian entity cannot give loan or guarantee to an overseas entity without having equity capital. And also for giving loan or for giving guarantee, minimum 10% stake is required to establish that it has got control of over the overseas entity. So this is the requirement as far as the reporting requirement is concerned under Rule 9, that whenever a remittance is required, any form of financial commitment is to be given by Indian entity to the foreign entity, then a form FC is required to be filed to authorized dealer. And in first instance, the form FC is filed, a unique identification number is allotted to that overseas investment, and then the first remittance will be allowed. For further remittances, because already UIN is generated, the Indian entity will just prepare for a form FC, report what sort of financial commitment is being done through that form, and accordingly remit either equity capital or give a loan or give corporate guarantee or performance guarantee. So for all future financial commitments, again, form FC is required to be filed at the time of making that financial commitment. So one important aspect with respect to the guarantees, because is what the obligation Rule 9 obligation says, that the Indian entity taking any financial commitment is required to report that financial commitment by filing form FC. So normally what happens, whenever money is to be remitted in the form of equity capital or loan, naturally the Indian entity approaches AD, is required to file form FC, and then only once the form is processed, the amount is remitted towards equity or towards loan. But in case of corporate guarantee or performance guarantee, what happens is, because these are non-fund based and thus only Indian entity is required to execute only those documents, what we have seen and observed is most of the cases, corporate guarantees and performance guarantees are executed first, and then Indian entity approaches FC to report them to AD. So under FEMA, under OI rules, it is treated as a non-compliance. So if an Indian entity is executing a corporate guarantee or a performance guarantee, then that Indian entity is required to approach bank before executing such corporate guarantee and or performance guarantee, file form FC, report that execution. So simultaneously, so along with execution, immediately that form is required to be reported and not afterwards. So there is no 30 days time limit for submitting form FC for corporate guarantee or performance guarantee. And in most of the cases, because these are document-based commitments, financial commitments, the documents are executed first, and then the documents are submitted with AD, which is treated as a non-compliance or delay in reporting, and accordingly, Indian entities are required to pay late submission fee. So, as far as the OI rules are concerned, the first compliance which gets triggered is whenever overseas investment is to be made, a form FC is required to be filed, and a unique identification number is required to be obtained. Now, in case if there are more than one Indian entities investing into a same foreign entity, so the same UIN is used, and all the future reporting is required to be done through the same bank. As we discussed, that once one entity is finalized for a particular UIN, even though let's say the second Indian entity does not have account with that AD, still the reporting is required to be done by the AD from whom the earlier form FC was, through whom the earlier FC was filed and UIN was obtained. So this is the first compliance as far as overseas investment rules is concerned. Then thereafter, once the remittance is done, what we need to ensure is that Indian entity is required to submit a proof of investment to the authorized dealer within 6 months of making the remittance. So again, normally what I have seen is once the remittance is done, the Indian entities forget about this compliance of reporting the proof of investment. So it's not very rigid compliance. It's a normal reporting which is required to be done, but which is normally ignored. So here, whenever a remittance is done towards equity, the Indian entity should ensure that a proof of investment in the form of share certificate is issued, or if suppose the host country law do not require issuance of share certificate as such, any form of acknowledgement of investment made by the Indian entity into foreign entity suffices, and such acknowledgement of investment is required to be submitted to the authorized dealer. So either it can be in the form of share certificates or in any other form, but that documentary evidence that the overseas entity has acknowledged that investment by an Indian entity is required to be filed with the authorized dealer within 6 months of the remittance. So this is required only in case of investment in the form of equity capital or CCPS. Whenever a loan is remitted, so obviously it is backed by the loan agreement and guarantees are given, it is backed by the corporate guarantees or performance guarantees. So this is second aspect as far as the reporting requirement is concerned, the submission of proof of investment. So third most important provision under Rule 9 is whenever an Indian entity makes overseas investment, any due receivable from such overseas entity is required to be repatriated to India within 90 days. And if that due is not paid within 90 days, it is treated as a non-compliance under Foreign Exchange Management Act. So if you are an auditor, if you are acting as a secretarial auditor of the company and looking into what all remittances have been made and what all commercial relationship is there between the Indian entity and foreign entity, what we need to see is, for example, if Indian entity has provided a technical know-how to an overseas entity and under technical know-how agreement, the certain fees either in the form of lump sum or royalty are due to Indian entity. So the moment what you need to check is, as per the agreement, when the amount becomes due. The moment that amount becomes due and payable, within 90 days from that day, the amount should be realized, should be repatriated to India. And in case if there is a delay, it is treated as a non-compliance. So if there is a declaration of dividend, then the moment dividend is declared, within 90 days of such declaration, the dividend should be repatriated to India. If any royalty is payable, the moment it becomes due, the royalty should be repatriated to India within 90 days. If any interest on loan becomes due, such interest on loan also should be repatriated within 90 days. So any sort of commercial arrangement where Indian entity is supposed to receive any payables from overseas entity, we need to ensure that those are repatriated to India within 90 days. If those are not repatriated within 90 days, then it is a non-compliance of Rule 9. So primarily under overseas investment rules, first is the reporting compliance at the time of making financial commitment. Then once the financial commitment is done, and if the financial commitment is in the form of equity shares, then there is a requirement of submission of proof of investment within 6 months of such remittance. And if there are any dues are receivable from foreign entity to Indian entity, then such dues are required to be repatriated within 90 days. So these are important obligations on an Indian entity which is making investment in overseas entity. So as we discussed, a Form FC is required to be filed every time whenever there is any financial commitment incurred by an Indian entity for the foreign entity. So I have given the list of documents which are required to be attached. So I'm going to share this presentation with all of you, so you can refer them afterwards. So because of the paucity of time, we'll not go line by line. So what we need to keep in mind is no remittance without obtaining unique identification number. Then no remittance should be done without submitting Form FC. In case of guarantees, as we discussed, the guarantees should be executed along with filing of Form FC. So there should not be gap in execution of guarantee and submission of Form FC. If Form FC is submitted afterwards, then it is treated as a non-compliance. All transactions are required to be routed through only one AD branch. And as we discussed, even though there are one or more Indian parties, reporting should be done through same authorized dealer. even though if the bankers of the other Indian parties are different than the AD which has dealt with this UI. Then once this Form FC is filed, unique identification number is obtained, proof of investment is submitted, you have ensured that all the dues are being paid within 90 days of they are becoming due. Then on an annual basis, under overseas investment rules, an Indian entity who has made overseas investment is required to file Form Annual Performance Report. So this is the mandatory requirement which is required. So Indian entity is required to report to Reserve Bank of India through authorized dealer. So to whom it is applicable? To a person resident in India having overseas direct investment is required to file annual performance report for every yuan. So here the word Indian entity is not used. Here the word a person resident in India is used. So as we discussed initially, either Indian entity can make overseas investment or resident individual can make overseas investment under LRS scheme. Sorry, within the limits of LRS scheme. So here, if an overseas investment is done by an Indian entity or by a resident individual, that person resident in India is required to file annual performance report every financial year. This APR is required to be filed on or before 31st of December from the end of the financial year of the overseas entity. So if the overseas entity's financial year has ended on 31st December 2023, then the due date of filing APR for such UIN will be 31st December 2024. Similarly, if the financial year has ended on 31st March 2024, again, the due date for that APR will be 31st December only. So the cutoff is defined. So it's not that 1 year or 9 months or 6 months from the end of financial year, which was earlier, but now it is very clear that the due date has been now fixed, which is on or before 30th of December. So many times, if overseas entities financial year has ended on 30th of June 2024, still the due date will remain 31st of December 2024, and Indian entity will have to ensure that the filing is done within the prescribed time limit. Then an APR should be prepared based on the audited financial statements of the foreign entity, irrespective whether host country mandates audit or not. So this is again an important change which has been done in OI Rules 2022. Earlier, the process of filing APR with respect to unaudited financial statement was different. But now, on the introduction of OI Rules 2022, RBI has mandated that APR can be filed only on the basis of audited financial statements of the foreign entity. So in many countries, now there are threshold exemptions for getting the financial statement audited. So it may happen, like for example, in Singapore, if the threshold is, let's say, 50 million turnover of say $50 million. And below that, if your turnover is less than that, then no audit is required. So in that case, if an Indian entity has set up a overseas subsidiary in Singapore, then what Indian entity is required to do is to comply with this requirement, although that audit is not mandatory in the host country, the Indian entity will have to get this financial statement audited either by the local CPA or by a chartered accountant in India. Earlier, authorized dealers were accepting the annual performance return, which were certified based on the audited financial statements, which are audited by the Indian chartered accountants. But recently, RBI has also taken a stand that only those chartered accountants who are eligible to certify those financial statements in the host country will be eligible to audit the financial statements of the foreign entity, and based on that, APR can be filed. So now there is a little gray area. The practice different from one authorized dealer to another authorized dealer. Up till now, let's say up to 6 months back, the practice which we are following is if the audit is not mandatory in the host country, the chartered accountant in India used to carry out a special purpose audit, and based on that special purpose audit, the audited financial statements of the foreign entity were prepared, and based on that, APR used to be filed by the certified by the statutory auditors of the Indian entity. But now, as I said, in last 2 months, there has been change in stand by Reserve Bank of India, for which now necessary representation is being made by the authorized dealers and also by the Indian entities, that practically it may not be always possible to find out a chartered accountant from India who is eligible to certify in the host country as well. So we may find more clarity on this, but just keep in mind that the annual performance return can be prepared only based on the audited financial statements and not on the basis on unaudited financial statements. Reporting of ODI is exempted if a person resident in India is holding less than 10% without control and there is no other financial commitment, and or foreign companies under liquidation. So only in these cases, the reporting of ODI is exempt. ODI means annual performance report is exempted. Otherwise, in all cases of ODI, annual performance report is required to be filed. A failure to file APR will put restriction on transfer of shares, making further ODI or financial commitment impossible. So now a lot of importance is given to this filing of annual performance report. If any APR is pending for previous financial year, then authorized dealer will not allow to make any further financial commitment in the form of loan, equity, or guarantee or corporate guarantee. So as a going concern, if an overseas entity requires any sort of funding, and if the reporting compliance is not done, then no further financial or no further funding is possible unless and until all the annual performance reports are filed by an Indian entity and those are taken on record by the Reserve Bank of India. So we discuss in next slide what document you have to refer to ensure that the APR is, although APR is filed with the AD, if there are any defaults or faults in that annual performance report, and if that APR is not processed by AD and it is not reached to the Reserve Bank of India's portal, then it is considered as not filed. So an Indian entity is required to ensure that APR is filed within time limit. Further, it is properly acknowledged by the authorized dealer and it is processed by the authorized dealer, and it is appearing on the project profile of the Indian entity with respect to that overseas investment. So in the end, any change, and last but not the least, any change in shareholding pattern of foreign entity and or step down subsidiary investment or disinvestment needs to be reported in APR only. So this is one more change which has happened in OI rules 2022. Earlier, under regulation 13 of old overseas investment regulations, any change in shareholding of an overseas entity or any step down investment by overseas entity was required to be reported within 30 days of such change. But now all these changes with respect to an overseas entity, either there can be a change because of additional issue of shares to any foreign party, whereby there is a change in shareholding pattern, or it may happen that the overseas entity has made downstream investment or step down subsidiary investment. So all such reporting are now clubbed in the annual performance report and are required to be reported only in APR and not on. So it is not now event-based reporting. It is now considered in the annual reporting. So if you are acting as a secretarial auditor of a company which has made overseas investment, what all documents we should ask for? The first is we should obtain project profile of the unique identification number from authorized dealer. So for each UIN, that means for each overseas investment, a project profile is created by Reserve Bank of India. This project profile provides all the information with respect to the Indian party and also the overseas entity. So how much financial commitment has been taken by the Indian party in the overseas entity? What is the share capital? What is the shareholding pattern of the overseas entity? What falls, in what manner the financial commitment is taken, like how much equity contribution has been done, how much loan has been given, whether how much corporate guarantee or performance guarantee. So all that detail, which the form FC, which are filed by the Indian entity to the authorized dealer, are captured in this project profile. Then this project profile also provides information with respect to the annual performance returns filed by the Indian entity. So as we discussed, that now APR has got a lot of importance. If an APR is pending for any financial year and if fresh financial commitment is required to be done, then authorized dealer does not allow further financial commitment without first filing all the APRs which are applicable to the previous financial year. So this project profile provides information with respect to the APR file, with respect to the proof of investment submitted with the authorized dealer, So it's a replica of, or it's a all foreign form FC which are filed to the authorized dealer. So it clubs all that information. And as an auditor, what you can do is you can refer to the financial statement of the Indian entity, see what sort of exposures have been taken with respect to that overseas investment, and then basically reconcile that with the information available in project profile. So you might come to know that, okay, certain form of corporate guarantees have been given. So it has been captured in the contingent liability of the financial statements of an Indian entity. But such corporate guarantees or performance guarantees are not reflected in project profile. That means there is a scenario where Indian entity has given a corporate guarantee, document is already provided to a foreign entity, but reporting of that in Form FC has not been done. So as an auditor, you can find point out that lacuna, a non-compliance, and in that case, that Indian entity will have to prepare a Form FC and report that particular corporate guarantee to the authorized dealer. Then ask for all Form FC plus related documents filed with the authorized dealer. Then once the Form FC is approved by AD and forwarded to RBI, RBI also approves it and issues unique identification number. And normally it is issued over email. So you can ask for a copy of email which provides details of UIN. So which also gives all the information with respect to Indian entity and foreign entity for which the UIN has been issued. Then proof of investment submitted by the Indian entity. Then also find out details of transactions entered between the Indian entity and overseas entity. So there can be a supply of goods or supply of services, or there can be a transfer of technical know-how or any sort of royalty arrangement, or there can be a loan agreement. So all sort of transactions, we need to find out what all transactions are there. As we discussed, why these transactions are important. Auditors should know this, that there are other commercial transactions happening between the Indian entity and overseas entity. And once, if there are such transactions, we have to, as we discussed in Rule 9, there is an obligation on Indian party to receive any due payable from a foreign entity within 90 days from the becoming due. So to check whether such dues have been realized within a specific time period, all these transactions are required. So we, as an auditor, we need to ask for copies of that. Then ask for copies of annual performance report filed with the authorized dealer. If APR is pending for any particular financial year, if there is no acknowledgement received from AD on submission of APR, so then it is treated as non-compliance. As I said, only acknowledgement from AD is also not sufficient. We have to see whether it was properly processed and it is appearing in the project profile. So if it is not appearing in project profile, it will be treated as a non-compliance. Suppose it so happens that APR is filed complete, which was correct. AD has given an acknowledgement, but at AD's end, AD has not processed it, and because of that, it is not appearing in project profile. So then you need to advise your client that they have to make proper follow-up with AD and get that information uploaded on the project profile. Otherwise, there will be a risk on the Indian entity that it is treated as a non-compliance. So if there is no further query from AD and APR has been filed, a proper acknowledgement has been taken, it is treated as a compliance. But if it is not reported on project profile or appearing on project profile, one has to make sure that why it is not appearing. So is it because of any query raised by AD, or it is because of the non-action by the authorized dealer? And accordingly, necessary action should be taken, and the Indian entity should ensure that the APR is reflecting on the project profile. Then ask for the audited financial statement for the relevant period to reconcile. So you might get all the information with respect to the foreign overseas investment filed with the AD from the entity, Indian entity, but to verify whether you have received everything and to reconcile that with the financial statements, you need to ask for an audited financial statement. Then go to the investment schedule, find out what is there any increase in investment amount. If so, whether it is tallying with the Form FC provided to you. Then if there is in the contingent liability, whether any corporate guarantee or performance guarantee has been issued, whether it is, if it is mentioned in the contingent liability but not appearing in project profile, or if it is mentioned in contingent liability, then you have to ask for the copies of Form FC filed. And if there is a gap, then you have to highlight those non-compliances. And in case of a disinvestment, where the Indian party has either partially transferred the shares or totally disinvested, then we have to ask for the Form ODI and now Form FC. Earlier it was ODI Part 3 and now Form FC Part G. And also see that whether the disinvestment has been done in compliance with the OI rules and regulations. That means the disinvestment has been done at a fair value, so for which you will ask for the fair value certificate. And if the disinvestment has resulted into any write-off, then we have to refer to the RBI guidelines with respect to write-off and see whether that write-off falls into the automatic route or whether it requires prior approval of Reserve Bank of India. So as a secretarial auditor, when you are auditing any overseas investment transaction, then we have to go through all these documents and then come to a conclusion that whether the Indian entity has complied with the requirements or not complied with the requirements. What are the common audit observations which we have come across? First is incorporation of an Indian overseas entity abroad without capitalization. So, like in Dubai or many countries like USA, an Indian entity can just set up a company abroad and no capitalization required. So you don't have to remit capital and start business activity. So entity can be just formed and the entity certificate of incorporation is issued. And based on that, that entity can start its business activities. So it so happens that Indian companies, they set up companies abroad, because no capitalization required, there is no requirement to approach the authorized dealer to file Form FC because no remittance is required in the form of equity capital. The bank account, everything is opened in the name of foreign entity, and the foreign entity starts its business operations by entering into a service agreement or sort of a commercial agreement with Indian entity. So Indian entity either supplies goods or avails services. So commercial relationship gets established, and with that the funding starts, where you are paying to the overseas entity under current account transaction. So in that case, what happens is an Indian entity is set up abroad. That entity starts its business activity, but no reporting is done to the Reserve Bank of India under OI rules. So this is treated as a non-compliance. So as soon as Indian entity sets up a company abroad, Indian entity is required to report that to the authorized dealer by filing Form FC. And in that case, a Form FC will have to be filed along with an Indian entity is required to give all the documentary evidence like memorandum, article, all the information with respect to the overseas entity, and a UN is required to be generated. So if suppose there is no capitalization requirement or a nominal amount of capitalization is required, and that also Indian entity is going to do in future, let's say after 2 months, 3 months, 4 months, or 6 months, that is treated as a deferred consideration. So in that case, also the moment an overseas entity is formed and Indian entity undertakes to subscribe even $1 of capital, it is treated as a financial commitment by an Indian entity. And the moment Indian entity formed, overseas entity is formed, the Indian entity is required to file Form FC and obtain unique identification number. So whatever we discussed with respect to the financial commitment, all those compliance are required to be done by Indian entity the moment overseas entity is formed, even though it is without capitalization. Then non-submission of proof of investment within 6 months of remittance. So as I said, the moment amount is remitted as capital, the work is done, and then a normal business starts, and Indian entity forgets to submit the proof of investment, so which is treated as a non-compliance. So we have to ensure that any form of investment in equity or CCPS, a proper proof of investment in the form of share certificate or any other document is submitted with the authorized dealer. Then providing corporate guarantee or performance guarantee without filing Form FC, that also we discussed, because these are just a financial commitment which are given in the form of executing documents. Normally, the corporate guarantees or these performance guarantees are executed, given to the overseas entity, but no Form FC is filed. So this is also one of the reason common audit observations. Then provide interest-free loans to overseas entity. So now, many a times what happens is, because it's fully owned subsidiary, the Indian entity feels that, okay, because otherwise also they are funding it by giving loan, why to burden that entity by charging interest? So many a times an interest is not charged. But as we discussed, after introduction of OI rules 2022, that is from August 2022, now it has become mandatory to charge interest on loan provided to overseas entity. So we have to ensure that all such loan agreements have clause with respect to the interest, how much interest is required to be is mentioned over there, whether what is the frequency at which the interest is required to be paid, and whether that is paid within 90 days from it becomes due. So that all we need to check. Then failure to recover the dues within 90 days from overseas entity. So this is also one of the common audit observations. Many times because these are the related parties, so the Indian entities do not insist for recovering this amount. And in that case, it becomes a non-compliance. The non-filing of Form FC on conversion of loan into equity of overseas entity. So now overseas investment rules allow conversion of loan into equity. So, however, what happens is because whenever the money was initially remitted, it was remitted as a loan. And then Form FC, which was filed, has reported that remittance of financial commitment as a loan. Now it has changed the color and that loan is converted into equity. So in that case, because there is a conversion of loan into equity, a Form FC is required to be filed and that information is required to be updated in the books of Authorized Dealer and Reserve Bank of India. This is also a common audit observation that this compliance is not done. Then last but not the least, a non-filing of annual performance report. So these are the common audit observations which we come across with respect to overseas investment rules. So this was all about overseas investment rules. Just to recapitulate what we discussed. First, what we have to see is whether Indian entity has filed Form FC while making the initial remittance, whether the unique identification number was obtained, whether the financial commitment is made within the limits, that is 400% of the net worth as per the last audited balance sheet. Then second, once the financial commitment is done or the investment is made in overseas entity, whether the proof of investment is filed within 6 months, and all these whatever common audit observations we discussed, we need to ensure that the Indian entity has not defaulted on those. If Indian entity has defaulted in any of these compliances, as a sectoral auditor, we are supposed to highlight this in the sectoral audit report. Now, with this, we will move on to the second important topic of Form OPI under overseas investment rules. Now, this is also what we observe that wherever there is a holding subsidiary relationship, that means a parent company is outside India, and that parent company has set up a wholly owned subsidiary in India, and employees of the wholly owned subsidiary are offered shares or ESOP of the parent company. So in that case, what happens is the employees who are resident individuals are getting shares of a foreign entity, a foreign company, where this has got exposure under Schedule 3 of overseas investment rules. So in that case, if you look at the transaction, what happens is a foreign company has issued ESOPs to the subsidiary of to the employees of the subsidiary of Indian subsidiary. So technically speaking, here Indian entity has not made any overseas investment. The employees of Indian entity are receiving ESOPs or foreign securities of a foreign company or holding company. But as far as the reporting compliance is concerned, under OI rules, the onus of reporting of such issuance of ESOP is on the Indian entity whose employees are being offered such ESOP or foreign securities or sweat equity of the parent company. And this also, as a sectoral auditor, what we observe that many a times Indian entities are either not aware of this compliance, or because here the shares are directly issued to the employees of this Indian subsidiary, or in case if there is any exercise price, and so that remittance also happens from the bank account of the employee to the foreign company, to the foreign holding company, and it is not routed through the Indian entity. So many times this compliance is not done within time limit or not at all done. So if you find a scenario where an employee of a foreign company has been, employee of an Indian company, which is subsidiary of a foreign company, has been offered employee stock option plan or sweat equity shares of a foreign company, then in that case, the compliance of Form OPI triggers, and the onus of such compliance is on the Indian company. And this compliance is required to be done half yearly. So now the return for 1st of April 2024 to 30th September 2024 is due, and due date of filing this return is within 60 days, it is required to be filed. So to whom it is applicable? So in this scenario, Apple Corporation USA is a US company. It has got a subsidiary of in US only, which is XYZ Inc. USA. This XYZ Inc. USA has got wholly owned subsidiary XYZ India Private Limited, and again XYZ India Private Limited has got wholly owned subsidiary ABC India Private Limited. In addition to this, this Apple Corporation USA has also set up a branch office in India. So as far as the form OPI is concerned, as we discussed, it is applicable to an Indian entity whose employees are offered ESOP of a foreign company. So in this case, XYZ India Private Limited is a subsidiary of XYZ Inc. USA. If the employees of XYZ India Private Limited are offered shares of Apple Corporation, then XYZ India Private Limited is required to file Form OPI. So either shares can be offered by XYZ Inc. USA or by Apple Corporation USA. So in both the cases, XYZ India Private Limited will have to file Form OPI. Similarly, ABC India Private Limited also again a subsidiary of XYZ India Private Limited, which is again its ultimate parent company is Apple Corporation and intermediary parent is XYZ Inc. USA. So if the employees of ABC India are also offered shares of XYZ or Apple, in that case also the compliance onus of compliance of filing OPI is on ABC India Private Limited. So this is only not restricted to the companies which are subsidiaries in India. This is applicable to also branch offices of foreign companies. So many times also this is ignored. So even though a branch office is not a separate legal entity, from FEMA point of view, the status of a branch office of a foreign company is a person listed in India, although it can function only within limited parameters as approved by the Reserve Bank of India and provided in FEMA regulations. But if employee of a branch office which is located in India is offered shares of a foreign company, then that branch office is also required to report this by filing Form OPI. So actually this is just a two-pager form where it requires information of Indian entity is required to be given. Plus mainly it talks about how much ESOP, net amount of ESOP or EBS investments held abroad, so which is the opening balance, then investments made during the half year. So if any remittances have happened during that 6 months period, then all those are required to be reported in here. Then disinvestments made during the half year. So if any redemption has happened and the money has come to India, that also is required to be given. And net amount of investment held abroad, the closing balance is required to be given. So although only 4 or 5 the line items are required to be reported, but practically these are very challenging getting all this information. So from a compliance point of view, as far as compliance under FEMA is concerned, whenever any such scheme is introduced by the parent company, the board of directors of Indian companies should acknowledge the issuance of such ESOPs in the board meeting. Then that scheme from income tax point of view also is required to be reported to the transfer pricing division of income tax, and a proper cognizance of this issuance of ESOP of the parent company to the employees of Indian companies is required to be taken. And if it amounts to additional perquisite, the taxation aspect is required to be considered. Withholding tax is required to be deducted. So a lot of compliance requirements are there for Indian company also in case of issuance of ESOP of a foreign company to the employees of Indian company. So from FEMA point of view, whenever such issuance is there, a Form OPI gets triggered, and it will get triggered whenever an Indian employee is remitting money outside India or any stocks are being awarded even without remittance are required to be disclosed in this form. So this was as far as the form OPI is concerned. As I said, although the compliance, there are only 4 or 5 line items where information is required to be gathered and reported to the Reserve Bank of India, but many times this is ignored. So now from overseas investment rules, we will move on to the external commercial borrowing guidelines and see what all documentary compliances and reporting compliance are required to be done in ECB guidelines. So if one has to study ECB guidelines in details, we'll have to refer to FEMA Debt Instrument Regulations 2019, then FEMA Borrowing and Lending Regulations 2018, which are called as ECB regulations. Then in addition to that, with respect to borrowing, we have to also refer to FEMA Deposit Regulation 2016 and FEMA Guarantee Regulations 2000. So once you refer to these regulations, you will have good hands-on on this topic with respect to external commercial borrowing. So whenever a company raises finance by issuance of any debt instruments, which is in the form of optionally convertible preference shares, optionally convertible or non-convertible debentures, or bonds or commercial papers, secured loan, unsecured loan, fixed deposit, or if there are any trade credits, then there is the compliance of ECB guidelines comes into picture. And in that case, an Indian entity who is issuing these instruments, debt instruments, will have to see whether that Indian entity is eligible to issue such instruments. The person who is basically the lender who is investing into such instruments or who is giving loan to the Indian borrower, whether he is eligible lender under ECB guidelines. And with all that, once the Indian entity concludes that such ECB comes into the automatic route, then it can further approach authorized dealer to get the necessary registration numbers and avail the foreign currency loan or rupee loan from such foreign equity, foreign lender. So as far as ECB guidelines are concerned, the borrowings, so either ECB can be under automatic route, and if any loan arrangement with a person registered outside India is not complying with the automatic route requirements, then it comes under the approval route. And in this case, the approval is required to be taken from Reserve Bank of India. However, one important everyone has to keep in mind with respect to ECB, unlike in foreign direct investment, whenever you say that an investment is under automatic route, that means you can receive the investment and then there is a post facto reporting to Reserve Bank of India. In case of ECB guidelines, even though the ECB arrangement is under automatic route, there is a quasi approval mechanism where you have to, the Indian borrower is required to submit that form ECB to the Reserve Bank of India. That form ECB is required to be certified by a chartered accountant or a company secretary, certifying that the arrangement, the ECB arrangement fulfills all the requirements of the automatic route. And based on such certification and further certification of the authorized dealer, Reserve Bank of India issues loan registration number, and only after issuance of such loan registration number, the Indian borrower is allowed to draw down the loan amount, and not unlike in foreign direct investment where the money is received first and the reporting happens afterwards. In ECB guidelines, although the arrangement comes under automatic route, unless and until loan registration number is received, no amount of loan can be drawn down by the Indian borrower. So this everyone has to keep in mind. So under ECB guidelines, there are list of entities given which are eligible to receive external commercial borrowing. So what the guidelines is that all entities who are eligible to receive foreign direct investment. So that means they are the eligible borrowers under ECB guidelines. So who are the entities who are allowed to receive foreign direct investment? So this the nomenclature uses foreign direct investment and not foreign investment. Therefore, RBI has clarified that only companies are allowed to receive foreign direct investment and LLPs are allowed to receive foreign investment. So therefore, RBI has clarified in its FAQ that even though LLPs are allowed to receive foreign investment, but they are not allowed to receive foreign direct investment. So LLPs are not eligible borrowers under ECB guidelines. So only companies who are eligible to receive foreign direct investment. That means if they are into any sector which are prohibited from receiving foreign direct investment, then such companies will not be eligible borrowers. Otherwise, all the companies who are eligible to receive FDI are eligible borrowers. So that those companies can be into manufacturing, software development, software services, service sector, hospital, infrastructure, trading, consultancy. So host of list of eligible entities, companies are there who are eligible borrowers under ECB guidelines. Then the guideline says that whenever there is any loan from a person resident outside India, that loan arrangement should comply with the minimum average maturity period requirement. And a formula for that has been prescribed by Reserve Bank of India. So an Indian entity who is borrowing from a foreign entity is required to put that details of the drawdown, details of the repayment into the formula prescribed and find out what is the average maturity period calculated based on that formula. And what the guideline says that based on the nature of use or based on the category of the lender, there are different minimum average maturity period requirement. Per se, the MAMP should be of 3 years, but in certain cases, it can be different than 3 years. For example, in case ECB is raised by manufacturing companies up to 50 million or its equivalent per financial year, then the minimum MAMP required is 1 year. In case the ECB is raised from foreign equity holder, now it is lender specific. So if the lender is foreign equity holder, and if the use is for working capital or general corporate purpose or for repayment of rupee loan, which is availed from local banks or local lenders, then the minimum average maturity period is 5 years. If the ECB is raised from other than foreign equity holders and which is used for working capital or general corporate purpose, then the minimum average maturity period is 10 years. So based on the nature of, based on the category of the lender and also the end use of the loan, we have to first ascertain what is the minimum average maturity period prescribed by the Reserve Bank of India, and then basically structure the repayment schedule. And that repayment schedule is required to be then put in this formula, and then we have to find out what is the MAMP based on this formula. And the product, so for example, in this example, the loan arrangement, there's a loan of 500,000 euro, and the loan is taken on 15th March 2022, and there is a repayment schedule where the repayment will start from 15th March 2026, and the repayment will be done in 5 installments. So this information has been now put in this formula, and the product of this is 3.5 years. So that means if this loan is for any say purchase of machinery or any other use, then the minimum average maturity period prescribed by RBI is 3 years. So this drawdown schedule fulfills the requirement of minimum average maturity period. So one has to first ascertain whether the repayment schedule fulfills this requirement or not. Then one has to see whether the lender who is giving the loan, either foreign currency loan or rupee loan, a lender located outside India, is eligible to is an eligible lender under ECB guidelines. So like the category of eligible borrower has been broadened. Similarly, the category of eligible lender also has been broadened. And now under the ECB guidelines, what it says that any lender who is from the FATF or ISCO compliant jurisdiction is an eligible lender under ECB guidelines and can give loan to an Indian entity. For example, let's say if there is a company in United States of America which has got surplus fund, and that company is not an equity holder of an Indian entity, Indian company, but wants to give loan. So what we have to see that an entity, whether that entity who's giving loan is from a Financial Action Task Force compliant jurisdiction. So USA is certainly a FATF compliant jurisdiction. So that company, even though that company is not related with Indian entity, becomes an eligible borrower, eligible lender. Then we'll see what the Indian entity is doing. So if Indian entity is into manufacturing of, let's say, auto components, so then that means that Indian entity is into a sector for which foreign direct investment is permitted. So in that case, then Indian entity also becomes eligible lender and eligible borrower. And because of this, the Indian entity can avail loan from the entity from USA under automatic route after complying with minimum average maturity period norms and all-in cost ceiling norms. So, and one more category of eligible lender is foreign equity holder. So in case of Indian entities having foreign investment, and so any foreign equity holder holding minimum 25% becomes direct foreign equity holder, and such entity or such direct foreign equity holder can give loan to an Indian company and under the category of foreign equity holder. And otherwise, if it is holding less than 25%, then as we discussed, like a company in US, if that foreign equity holder is from FATF compliant jurisdiction, then also it becomes eligible lender, but that entity becomes eligible lender in other category. But if it is a foreign equity holder holding not less than 25% stake, then it becomes direct foreign equity holder, where the minimum average maturity period is less as compared to the other foreign equity, other lender. So assume a scenario that Indian entity is a wholly owned subsidiary of a German company, and German company wants to give loan for a working capital requirement. So here, because a German company is a foreign direct equity holder, it will fall into the category of say serial number B, where because the end use of that loan is working capital, the minimum average maturity period is only 5 years. Suppose if this German company is not a foreign equity holder and just holding 5% stake, then it will be treated as an other lender, and it will fall into the category of at serial number C, which prescribes the minimum average maturity period of 10 years. So based on the nature of the lender, if the lender is foreign equity holder, the MMP goes down to 5 years. If the lender is not foreign equity holder, but other eligible lender, then it goes to 10 years or 7 years, depending on the nature of lender. So we have to, how to find out whether the lender is a direct foreign equity or indirect foreign equity holder. We have to see how much percentage of equity stake it has got into Indian entity. Similarly, there is a concept of indirect foreign equity holder also. So, and if the overseas entity is an indirect equity holder, still it is permitted to classify as in the category of foreign equity holder, and minimum average maturity period of 5 years will be applicable for such arrangement. So, with respect to now, because I directly come to the process involved and reporting requirements under ECB. So whenever there is a loan which comes under external commercial borrowing guideline, that means a loan is being raised by an Indian entity from a foreign lender, and it is complying with all the requirements of the automatic route conditions of Reserve Bank of India. That is, the Indian entity is an eligible borrower, the foreign entity is eligible lender, then it is complying with the minimum average maturity period norm. Then the end use also is not coming under the negative list, and the end use is also permitted. And the all-in cost ceiling, that means the interest whatever is being paid for such foreign currency loan or any other cost incurred in connection with raising the foreign currency loan comes under automatic route. Then in that case, application can be moved to Reserve Bank of India under the automatic route. As I said, even though it is under automatic route, unless and until the loan registration number is allotted by Reserve Bank of India, no drawdown is possible against that loan arrangement. So what the process is required to be followed, once it is concluded that all the parameters of automatic route are complied with, a loan agreement is executed between the foreign lender and Indian borrower. Within 7 days of execution of loan agreement, a form ECB is required to be submitted. So this form ECB gives all the details with respect to the Indian borrower, with respect to the foreign lender, then the drawdown schedule, the end use of the loan, then what is the all-in cost ceiling, all the information with respect to the interest paid, other costs paid for arranging the loan. So all the information is captured in form ECB. Then this form ECB is signed by the Indian borrower. Then it is certified by either chartered accountant or company secretary that this loan arrangement is fulfilling all the requirements of automatic route. Further, it is certified by the authorized dealer that this loan arrangement is complying with the automatic route requirements. And based on the certification given by the chartered accountant or company secretary and the authorized dealer, Reserve Bank of India's ECB division processes the ECB and issues loan registration number. So a loan agreement is executed within 7 days. Form ECB is filed along with the documents with authorized dealer. So in case of, suppose the lender is foreign equity holder, then Indian borrower is required to submit necessary documents with respect to a proof of submission of form FCGPR, a proof that the foreign lender holds more than 25% stake. So all such documents are required to be given to the authorized dealer, based on which authorized dealer certifies form ECB and forward this to the Reserve Bank of India. And based on that, a loan registration number is obtained. Once the loan registration number is obtained, till the entire repayment of the loan, the borrower is required to file form ECB2, which is a monthly return. So this is the requirement. The moment, so as far as the ECB guidelines is concerned, with respect to the event-based requirement, the first requirement, whenever there is such loan agreement, a form ECB is required to be filed and loan registration number is required to be obtained. So this is going to be one time. And then every month, whenever till the entire loan is repaid, the Indian borrower is required to file Form ECB2 within 7 days of the from end of the every month to the authorized dealer. So this is monthly compliance till the entire loan is repaid. So what are post LRN compliance? That means once the loan registration number is allotted, the Indian borrower is required to file Form ECB2, which is a monthly return. The provision says that the loan ECB2 return is required to be filed from the issuance of LRN, but practically the authorized dealer insists to file Form ECB2 return from the date of execution of agreement. So for example, if the agreement is executed, let's say on 15th of September 2024, and it is forwarded to Reserve Bank of India, and let's say the loan registration number is allotted on 14th of October 2024. So almost after 1 month. So LRN is allotted in the month of October. So now all the ECB2 return filing compliance will trigger. But as far as the compliance for the September is concerned, authorized dealers also asked to submit ECB2 return from the date of execution of the loan. So practically, even though the submission of ECB2 return will start after getting LRN, ECB2 returns will also have to be filed from the effective date of the loan. So if the loan is, say, agreement is executed in August, and for some reasons the LRN is allotted in October, the ECB2 return will have to be filed for August as well as for September, and then from October onwards it will have to be filed till the entire repayment is done. So this monthly return provides details of drawdown, then utilization, debt servicing. So whatever has happened with respect to that loan, that is required to be captured in that monthly return and reported to the Reserve Bank of India. Then this monthly return is required to be certified by a chartered accountant or a company secretary. So based on which RBI takes this on record. So a lot of importance and onus is on the professionals to make sure that the ECB2 returns are properly certified. So each and every information is required to be properly checked. And so the professional is required to see whether the drawdown is done as per so if the end use which is reported in the loan agreement and in the initial ECB is for, say, capital goods, and if the end use is actually done for the working capital requirement, then it is a deviation. So in that case, so the professional will have to highlight that deviation and it will be treated as a non-compliance. So whenever ECB2 return is certified by a professional, always that ECB2 monthly return will have to be checked with the actual data. So if there are payments done during the year, either loan is repaid, then it has to be cross-checked by necessary documents which are filed with the authorized dealer. If the loan is utilized for some purpose, then proper invoices and everything will have to be checked by the professional before certifying that return. Then the provision says it should reach Department of Statistics and Information Management (DSIM) of RBI within 7 working days from the end of the month through authorized dealer. So what happens is this ECB2 is prepared, then it is certified by a professional, then it is required to be filed with AD, and the provision says that it should reach Reserve Bank of India within 7 days. So if the filing is done on the 7th day to the AD, then certainly AD is not in a position to process the form and forward to RBI within 7 days. So it will amount to non-compliance, and there the Indian borrower is required to pay late submission fee. So here the Indian borrower is required to ensure that this monthly return is filed, let's say, on 3rd day or 4th day, which gives sufficient time to the bankers to process the form and forward the same to the Reserve Bank of India within 7 working days. So this was as far as the monthly reporting is concerned. And as I said, this monthly ECB2 return is required to be filed till the last amount is paid. So during the entire tenure for all the months, this ECB2 return is required to be filed. Then there are further event-based compliances under external commercial borrowing guideline. So what it says is if there is any change in whatever information is filed with the Reserve Bank of India with respect to that loan earlier in Form ECB. Let's say if there is a change of the name of the borrower, change of address of the borrower, change of name of the lender, or if there is a change of drawdown schedule, or if there is a change of end use or change of repayment schedule. So any change, so whatever information was first given to the Reserve Bank of India in initial Form ECB, if there is any change, then that change is required to be reported to Reserve Bank of India by filing revised Form ECB. So as I said, the change can be with respect to change in name of the borrower or lender, change in drawdown schedule, repayment schedule, change in interest rate, change in utilization. So whenever a professional is certifying a monthly return, and if a professional comes to, if any change comes to notice to the professional, then first the professional should check that whether Form ECB is filed and this change information is updated to Reserve Bank of India or not. If it is not, then first the certifying professional should insist the borrower to file Form ECB, report that change to the AD and Reserve Bank of India, and then certify the monthly return. So in ECB guidelines, there is one more concept which triggers compliance, ECB guideline compliance, and it is treated as a trade credit. So with respect to trade credit, although as far as the Indian importers are concerned, the reporting requirements, there is no reporting requirement as far as Indian importers are concerned. The onus of reporting is with the authorized dealer. So considering the paucity of time, I will just skip this. But the trade credit guidelines suggest that as per the import regulations, any payment for import is required to be done within 6 months from the date of shipment. So if an Indian importer is importing raw material other than capital goods, raw material consumables, then trade credit guidelines allow an extended credit up to 1 year from the date of shipment. So a normal credit period is 6 months. Under trade credit arrangement, it allows a credit period up to 1 year. If the import is of a capital goods, then trade credit guidelines allow that repayment schedule up to 3 years. So this extended credit period beyond 6 months is treated as a trade credit. And whenever there is such trade credit arrangement, such trade credit arrangement is required to be intimated to the authorized dealer. But the reporting requirement with respect to that is with the authorized dealer and not with the Indian importer. So what are usual contraventions which we see? Drawdown of ECB before obtaining LRN. So as I said, although the ECB is under automatic route and is complying with all the requirements, fulfilling all the requirements, still unless and until loan registration number is allotted, no drawdown is possible. If an Indian borrower gets any money from a foreign lender without obtaining LRN, that is treated as non-compliance. Then delay in filing ECB returns, it's a usual non-contravention. Changes in terms not intimated within 7 working days. Availing ECB for restricted end use, or the end use is changed, but the repayment schedule is not changed. For example, initially when the Form ECB was filed, the end use is shown as purchase of capital goods, where the repayment schedule allowed is 1 year for manufacturing company, and after money is received, the money is used for working capital. So this is a deviation which is treated as a contravention. So in this case, if suppose such a borrower wants to now change the end use, then that borrower will also have to change the minimum average maturity period. So if the earlier average maturity period is 1 year, then that borrower will have to increase it to 10 years or to 5 years, depending on the category of lender. So this is also a usual contravention which is normally seen. Then loan from unrecognized lender. We saw who are the recognized lenders. Now the list of recognized lenders is also broadened. So any lender from FATF or ISO compliant jurisdiction is now eligible lender. Only in case of an individual, a person is not outside India, an individual can be a lender only if that individual holds equity stake in an Indian company, at least 25% equity stake in Indian company. Otherwise, individuals, foreign individuals are not eligible lenders. But other than foreign individuals, any body corporate outside India, which is from a ISO compliant or FATF compliant jurisdiction, is a recognized lender. Then deemed ECB, which is advance against supply of goods pending for more than 1 year. So where so there are scenarios under FEMA, where the Indian entity has basically booked expenses which are payable to the foreign entity, and those expenses are outstanding for more than 3 years, 5 years, 7 years. So RBI has taken a view that okay, otherwise in normal circumstances you were required to submit this to pay this within 6 months, but now even after 3 years you have not paid those. So these are treated as deemed ECBs, and RBI has asked such Indian entities to get this non-compliance compounded, and after levying compounding fee, RBI has regularized this non-compliance. Also, with respect to receipt of export advance from foreign customer, if the export is not done within 1 year, neither the export advance is returned to the foreign customer, RBI in many cases has considered this as a deemed ECB and has levied considered as a non-compliance of ECB guidelines and levied penalty. So, as a second auditor, if you are auditing a company which has availed foreign currency loan or rupee loan from a person resident outside India, which trigger ECB guidelines, what you need to do is ask for copies of loan agreement, copies of Form ECB. Earlier, it was Form 83 and loan registration number thereon. Then ask for copies of monthly ECB to return filed with AD. So you have to cross check with the whatever form ECB is filed, whatever loan agreement is executed, whether the end use is done as per that, whether monthly return has been filed. So check whether the company has obtained ECB as per prevailing ECB guidelines. Then check whether the drawdown and utilization has been made as per ECB form. So everything, whatever has been reported in form ECB, strictly we have to see whether that borrower has stick to those drawdown schedule and repayment schedule or the end use requirements. And if there is any deviation, as a secretarial auditor, we have to highlight that highlight that non-compliance in the secretarial audit report. In case of any modification, whether revised form ECB has been filed, and check monthly returns filed within 7 days from the end of the month. So this is as far as the function of secretarial auditor is concerned. We have to see. Now we will discuss compliances, reporting requirements under foreign investment, documentation and reporting aspects. So I think most of us are that way well versed with the requirements of filing form FCGPR and filing form FCTRS, which gets triggered in case of foreign direct investment under Schedule 1. So any company which has received foreign direct investment is required to report that to Reserve Bank of India by filing form FCGPR. And in case of transfer of shares, in the Indian entity, the resident transferor or transferee is required to file form FCTRS. So I think I will not take, so I'm going to share this PPT so you can refer to the requirements of filing form FCGPR and FCTRS. I would like to actually discuss more on the downstream investment and other forms which are normally not discussed. So first and foremost, filing a form ESOP. So as we discussed, in case of overseas investment rules, where the subsidiary of Indian companies are offered shares of a foreign company, and in that case, for Indian subsidiary or Indian company is required to file form OPI as a compliance, which is a half yearly return. In case of foreign direct investment, where Indian company has issued shares to any non-resident employee or has issued shares to the non-resident employees of holding company outside India or employees of the joint venture or wholly owned subsidiaries outside India. So here, under foreign direct investment guidelines, Indian entities are permitted to issue ESOP or sweat equity shares to employees or directors who are resident outside India of itself, means of that company itself, or its holding company, or joint venture company, or wholly owned subsidiary, or subsidiary outside India. So, if there is an event where stock options have been granted to the employees who are non-residents located outside India, so either those employees can be employees of that company or of its holding company or a joint venture or wholly owned subsidiary outside India, then which are in compliance with the provisions of Companies Act, if it is a closely held company, or in compliance with the provisions of SEBI Act, as per SEBI guidelines, if it is a listed company. In addition to that, the ESOPs can be done in compliance with the sectoral cap. So if there are sectoral caps and conditions, let's say, for example, if the company is into pharmaceutical and under automatic route, it can receive investment up to, let's say, 74%. And here now 74% is already consumed. And now the Indian entity is issuing ESOP, and ESOPs are being issued to non-resident employees. So in that case, obviously, it is going to breach the sectoral cap when the ESOPs are converted into shares. So in that case, issuance of such shares will obviously trigger central government approval. But if it is within the limits, then the stock options can be offered, granted to the non-resident employees. Same, you must have read news in today's Economic Times, where Reserve Bank of India has confirmed its view that, like press note number 3, 2020, where there is a restriction on foreign direct investment from countries, from entities who are from countries sharing land border with India. Similarly, if there is any issuance of ESOP to either the residents or to the employees who are residing in any of these countries who are sharing land borders with India, then such issuance will also require prior approval of central government. So with that keeping in mind, under foreign direct investment guidelines, Indian entity is eligible to issue employee stock option ESOPs or sweat equity shares to the eligible employees. And once it has issued such ESOPs, then it is required to file Form ESOP within 30 days from the date of issuance of ESOP. So here, the difference is you are just granting an ESOP, so there is no remittance as such, so only right is created. The moment there is an issuance of such ESOP, then the compliance of reporting will trigger, and form ESOP is required to be filed by such Indian entity who is granting the ESOP to non-resident employees. So as far as the overseas investment rules are concerned, if Indian entities employees are getting shares of foreign company, then Indian entity is required to file Form OPI. Here in this case, if Indian entity is issuing shares to its employees or other eligible employees who are non-residents, then Indian entity is required to file Form ESOP. Now, another important concept which I would like to discuss and which is very important to understand. And now we see wherever the companies are foreign owned or controlled companies, many times this compliance is ignored, or many times whenever a company is acquired by any foreign company, and if it has already got downstream investment under its belt, then in that case, this downstream investment reporting requirements immediately gets triggered. And many a times, this is either not intimated to all the companies who are in the structure, and this compliance is normally not done by such companies. So we'll discuss in detail when the downstream investment reporting requirements trigger and who is supposed to report that, and if yes, how to report and to whom to report. So downstream investment means whenever an Indian entity which is having a foreign investment and which is either foreign controlled or where more than 50% of capital is owned by person resident outside India, or where it is controlled by person resident outside India, then Indian entity, that Indian company is treated as foreign owned or controlled company. And in that case, whenever such company makes any further downstream investment, all the conditions which are otherwise applicable to foreign direct investment are applicable to such investment. So the underlying principle for downstream investment is what cannot be done directly under FDI also cannot be done indirectly by way of downstream investment in other entities in India. So let's say there is a company which is FOCC, which is foreign owned or controlled company. And in that case, if it wants to acquire a company which is into an activity which is prohibited for foreign direct investment. So in that case, just because that company which is acquiring is an Indian company, will not become eligible to invest in to have a downstream investment, which otherwise FDI is not allowed. So here, what it says, how to conclude that whether the downstream investment guidelines will be applicable or not. We have to ascertain whether the Indian company which has received foreign direct investment is FOCC or not. So what it says, if an Indian company is not owned and controlled by any person resident in India. So ownership of an Indian company shall mean beneficial holding of more than 50% of the equity instrument of such company, and ownership of an LLP shall mean contribution of for more than 50% in its capital and having majority profit share with the resident Indians citizens. So here, what parameter we need to apply is we have to see the shareholding pattern of the Indian company. So in this picture, this IC is the first level company. And in this IC, if foreign investor is having more than equal to or more than 50% stake. So even equal to 50% means Indian entity is not having more than 50% stake. Indian citizens or Indian entities now not having more than 50% stake. So if in Indian company, foreign investment in equity is equal to 50% or more, or if it is controlled by a foreign investor, let's say the equity investment is, let's say 30%, but there is a shareholders agreement where all the veto rights and rights to have a substantial power of management are given to such foreign investor, then we can conclude that although the investment is less than 50%, this Indian company is controlled by the foreign investor. So if either of this scenario happens, either equity is more than equal to or more than 50%, or it is controlled by foreign investor, the Indian company IC first level will become foreign FOCC, which is foreign owned or controlled company. The moment it becomes FOCC, if it makes any further downstream investment, which is second level investment as far as India is concerned, will trigger downstream investment reporting requirements. So the moment a foreign Indian company, which is a foreign owned or controlled company, makes any further downstream investment, then such investment is required to be reported under Regulation 11 of Foreign Exchange Management, Mode of Payment and Reporting of Non-Debt Instrument Regulation 2019. There are two types of reporting which are required in this case. First is the Indian FOCC, which is investing into another company, is required to notify Secretariat of Industrial Assistance, DIPP, on FIFP portal within 30 days of making such investment. So here the compliance triggers the moment the amount is remitted. So even though the shares are not allotted, let's say on 1st of September, the Indian ICO 1 has invested into ICO 2. And so the moment first the money is been transferred on 1st of September, the compliance with respect to notification to SIA will get triggered. And within 30 days of that, ICO 1 should have reported to on FIFP portal with respect to this downstream investment. So this is first the moment the money is remitted, irrespective of the date on which shares are actually allotted. So if the shares are allotted because 60 days time period is there, the shares are allotted on, let's say, 10th of October, then the second level of compliance will trigger. So within 30 days from the date of allotment of capital instruments, a Form DI is required to be filed with the Reserve Bank of India. So first reporting is to the Secretariat of Industrial Assistance on FIFP portal, and second compliance or second intimation or for reporting requirement is on the firm's portal of Reserve Bank of India by filing Form DI within 30 days from the date of allotment of capital instruments. So first is from the date of investment, second compliance is from the date of allotment of capital instruments. So which sort of investments are covered? Equity shares, compulsory convertible preference shares, and compulsory convertible debentures. So all the equity instruments. So if an FOCC invests into another Indian company in any form of equity instruments, then this compliance will trigger. If Indian company FOCC has given loan to another company, this downstream investment reporting requirement will not get triggered. If it is invested into non-convertible debentures or optional convertible preference shares, again, this compliance will not get triggered. So purely this will trigger only when an equity instrument is acquired by FOCC into another company. So just to give a more clear picture, here there's a person resident outside India, A, so which is an entity outside India. A has made investment into B. B is a foreign owned controlled company, foreign owned or controlled company in India. So it's a B private limited, let's assume. So entity B invests in entity C, which is again, let's say C private limited. So which is treated as a downstream investee company. and B is treated as a downstream investing company. So as far as the reporting, the onus of reporting is concerned, the onus of reporting is on entity B. So entity B is required to file intimation with SIA. Entity B is required to report by filing Form DI. However, because this is the information is given with respect to the share capital of C company, while reporting Form DI on the firm portal, the entity user of C will be created and business user of entity C will be created, and B company, which is FOCC, will have to file Form DI by using the entity user details of entity C. So the data with respect to entity C is reported to Reserve Bank of India, but the onus of reporting or filing Form DI is on the entity which is making the investment. So see, normally in case of foreign direct foreign investment, the form FCGPR is filed. So where the reporting requirement is on the company which is issuing the shares. So, but in case of downstream investment, the entity which is issuing shares is not under obligation to report, but the company which is making downstream investment is required to report, but it has to use the entity user credentials of the entity in whom investment is being made. So, the step 1 DPIIT reporting, I have given what are the list of requirements are there, and attachments are required to be attached while giving this intimation to SIA. Then in connection with step 2 DI filing also, how to create a entity user, then business user, and what all documents are required to be filed. So that also I have provided. There's an entire list of documents which are required to be given, because many a times if it is a multi-layer structure and if the FOCC has been acquired or the ultimate holding company which is in India has been acquired by foreign company, then there can be a scenario that the company which are second or third level subsidiaries might not even come to know, but this compliance gets triggered for them also. So what we need to keep in mind, practical aspect, that while filing Form DI, these are the major causes of rejections. Ensure that the valuation report shouldn't be more than 90 days older than the date of allotment. So as we discussed, even though this is investment within India, a downstream investment is required to comply with all the required terms and conditions of foreign direct investment, be it the sector, be it the pricing guidelines or the nature of instruments. Everything is required to comply with the FDI norms. So accordingly, whenever a company A is investing into company B, the fair valuation of company B shares is required to be done. That valuation report should not be more than 90 days old. Then amount of remittance and amount of consideration is not matching exactly. So we have to attach clarification if there is a difference in the amount of remittance and amount of consideration. I think I have given most of the reasons which we have come across. More importantly, with respect to annual reporting compliance. So it's not that once you have reported on DI, your reporting ends. The moment there is a downstream investment, like in foreign direct investment, annually any company which has received foreign direct investment is required to file FLA return. Similarly, in case of downstream investment also, there are annual reporting compliance. So now, what are those annual reporting compliance? The first level Indian company making downstream investment is responsible for ensuring compliance with provisions of these regulations for the downstream investment made by it at second level, and so on and so forth. So whoever the Indian company, the first level Indian company, which is FOCC, whenever it is making downstream investment in another company, it has to see that all the FDI requirement has been fulfilled and accordingly investment is made. And then further, when the second level is making investment to third level company, again same, it will have to ensure that all FDI related compliance are being met, or terms and conditions are being met. Then on an annual basis, the first level company shall obtain a certificate to this effect from its statutory auditor on an annual basis. Such compliance of FEMA provision shall be mentioned in the director's report in the annual report of the Indian company. So FOCC is required to obtain a certificate from statutory auditor that the downstream investment and Downstream Investee Company has complied with the Downstream investment norms on an annual basis. And so if there are any deviations, for example, there is a restriction on, say, multi-brand retailing. And if the initial investment is made on a wholesale cash and carry business, and say the Downstream Investee Company was into wholesale cash and carry business, then it changed its business and entered into a retail trading, which is otherwise doesn't come under automatic rule. So in that case, there is a violation. There is a so the statutory auditor will have to highlight that violation, and in case of there is any violation, so on an annual basis, a company which has made downstream investment in the director's report will have to mention this fact that a necessary certificate from statutory auditor have been obtained on an annual basis and there are no non-compliances. If there are any non-compliances or disqualification by the auditors, or if there is any qualified report, then the same is required to be immediately brought to the notice of regional office of the Reserve Bank of India, in whose jurisdiction the registered office of the company is located, and shall also obtain acknowledgement from the RO. So this is the responsibility on the company that immediately this qualification is required to be reported to the jurisdictional regional office of the Reserve Bank of India. So common non-compliance in downstream investment, failure to file intimation to FIFP. So most of the time within 30 days, it is not done. Many times what happens is that if companies having 2-3 layers of subsidiaries, so as we discussed, if the first layer it becomes FOCC, immediately the DI reporting triggers the moment the first level becomes FOCC. So the second layer, third layer will have to immediately report about they becoming a indirect, having an indirect foreign investment. So many times it is observed that there is a failure to file intimation when such acquisition happens, then failure to file Form DI, then acquisition of shares on a deferred payment basis. So RBI has clarified that under FDI guidelines, a foreign entity can acquire shares on a deferred payment basis. So where 75% can be paid upfront, 25% can be paid within a stipulated time period. But RBI has clarified that because there is no specific provision made for downstream investment, FOCC cannot acquire shares of another company on a deferred payment basis. If that is done, that's a non-compliance. Then issues when ultimate parent of existing structure become FOCC, as we discussed, for intermediary companies, unless they are informed that their ultimate parent has become an FOCC, they are not in a position to know that they have to comply with the downstream investment requirements with respect to their investment in another companies, and obtain statutory auditor certificate on compliance of downstream investment guidelines, and failure to cover audit observation in the director's report. So I think that's all. If anyone has a query, then I would be happy to answer the queries.
So we have received questions from participants, and
Yeah,
I'll be reading them one by one.
Yes.
So first question is, as per MCA notification on demat of shares, all the share transfers after 30th September 2024 must be done in demat only. What about cases where the SH4 is executed before 30th September 2024 but presented to the company after 30th September 2024? Can the board register the transfer after 30th September 2024, or it must return for demat?
This is not pertaining to Foreign Exchange Management Act, but I'll give my views. So if it comes for transfer after 30th September, in my opinion, the share should be dematerialized and then only transferred. But this query doesn't pertain to FEMA.
Okay, sir. Next question is, in case of ODI, share certificate was issued by the foreign subsidiary company prior to the date of remittance. Is this transaction considered as a violation?
Yeah, so RBI is considering that you have acquired shares on a deferred payment basis. So where shares are already allotted, but the payment. So earlier there was no such specific provision, but now in OI rules, considering these practical issues, RBI is not treated as non-compliance as such. But the moment shares are allotted, that means you have undertaken to subscribe those shares, and share certificate has been issued. the Form FC is required to be filed, and that is treated as a deferred consideration. So you are paying on a deferred basis in future. So there should be a documentation in place which should provide a time period within which that deferred payment should be done. So for example, if the certificates are issued on 1st of October, and then you should have a document which says, okay, you have to subscribe to these shares on or before 31st of December or 31st March. So there is no time period prescribed. It can be any period, but there should be clarity on that, and RBI is allowing that. But the compliance of filing Form FC triggers the moment you get share certificate.
So next question is there any limit for overseas investment for hospital industry, running hospital and consultation, etc.?
Yeah, so what we have to see is whether that hospital is a company or a LLP or a registered partnership firm. If yes, then it can invest up to 400% of its net worth as per last audited balance sheet. So they are allowed to invest. There's no problem. Within the 400% limit, they are allowed.
Okay, sir. So next question is, in case of share transfer between resident to resident, the consideration has been received by the resident transferor after execution of SH4 and after board approval for the said share transfer. Will there be any issue while reporting in FCTRS?
Okay, so FCTRS compliance trigger when you are transferring the shares or when you have received the money. Ideally, you should have received the money before and then approve the transfer. But we have to see if there is a time gap. So let's say share transfer is done on 1st of October, 1st of September, and now the money is received. So there it will be treated as a deferred. So it may be treated as a non-compliance. In ideal scenario, as a condition preceded, the money should be remitted to the account of the transferor. Then document should be executed and placed before the board for approval. So if SH4 is already executed, board has approved the transfer, and then consideration is issued, and if there is a considerable time gap, it may be treated as a non-compliance.
Okay, sir. Sir, if we have corporated joint venture overseas, can Indian company provide performance bank guarantee on behalf of overseas UGV partner?
Unincorporated? No.
Yes.
No. That is
joint
so basically,
venture.
So there, if you have received any, if you have filed a so bid, whatever, if there is AOP is formed, that AOP is treated as unliability with a unlimited liability. So presently, OI rules allowed to make investment only in the form of in the entities which are having limited liability. So AOP is treated as unliability company, unlimited liability company, where it is not an eligible entity to make overseas investment. So performance guarantee cannot be given to such AOPs.
Okay, sir. So next question is, if the limit of loans or investments exceeds 400% of the net worth, is there any approvals required?
Yes. So basically, the bank will not allow you to make the remittance beyond 400%. If you have to remit beyond 400%, then prior approval of Reserve Bank of India is required, where that Form FC is filed under approval route, Reserve Bank of India. We have to justify the reason, what benefits will get accrued, and what is the reason of going beyond 400%. If RBI is satisfied with the submissions, RBI may give permission, but otherwise, RBI will not give permission. It requires prior approval.
Okay. Okay, sir. So next question is, can a sole proprietorship company not registered as OPC make investment in foreign company or become a holding company by means of meagre investment required for that overseas company?
Okay. So basically, sole proprietor is not a separate legal entity. So it's a proprietor himself. Okay. So as we discussed, an individual can set up a company abroad under OI rules within the overall limit of liberalized remittance scheme. So where $250,000 one can spend, can go outside India, spend on vacation, can buy more property. So all other eligible current account or capital account transactions are there. So similarly, if an individual wants to set up a company abroad in his name, not in the name of proprietary firm, the Form FC can be filed and he can become shareholder of that overseas company by investing, say, $100 or that is possible.
So next question is, if an Indian entity wants to make an ODI in a proposed company, does the Indian entity has to submit the form FC before the incorporation, or is there any other process? What if the proposed company is in IFSC?
Okay, so it's not required to be filed before filing before incorporation of the foreign entity. Okay, once the foreign entity is formed, and when you are remitting money towards capital, that form FC is required to be filed. But normally, in many a times, like in Dubai or in countries where there is no requirement of capitalization, so you don't have to actually remit money towards capital, but company can start its business activity. In that case, what is advised is, and there the certificates are issued that okay, these are so in that the moment company is formed, it is advisable to prepare form FC, submit the details with the authorized dealer bank. But practically, I have seen bank they do not accept unless you are remitting towards capital. But suppose there is a scenario where the certificate has been issued, you can attach that certificate, attach all the legal charter of the foreign entity incorporation certificate, and file form FC. So your intent is very clear that you want to intimate AD immediately on formation of the company, and the AD should process and forward to RBI. But this will happen post incorporation of the company, not pre incorporation of the foreign company.
Okay, sir. Sir, what if the proposed company is in IFSC? Same.
Same. Yeah.
Same.
Because IFSC is treated as a foreign territory as far as FEMA is concerned. So,
Right.
OI rules will be same for both.
Okay, sir. If there is an IFSCA entity, then is there any requirement that IFSCA entity too has to file APR?
IFSCA entity will not have to file, but I'll confirm that. But the Indian entity which is making investment into IFSCA entity will have to file APR.
All right, sir. So next question is, if a company has incorporated an overseas subsidiary outside India, but no investment has been made, when should we file Form ODI? This means only expenses relating to incorporation are made, and no other investment is made.
Got it. So I have also handled 2-3 such scenarios where the company was formed in USA, say in the year 2016, and the company was formed, account was opened, and then Indian company just signed the documents and business started. So no, as I said, because no capitalization was required, there was no requirement of approaching AD bank and filing form ODI or form FC. But there, then it's a non-compliance, because the moment you set up a company abroad, if you look at the definition of overseas direct investment, it says even the subscribing to the memorandum is also treated as an activity of foreign investment. So you are undertaking to subscribe certain shares. So in that case, this company Indian entity should have filed form FC or earlier form ODI immediately on incorporation of the foreign entity. So practically what is suggested is, even though the capitalization is not required, the moment company is formed, you prepare form FC, just remit $100 as capital. So so there is a remittance involved. You get a share certificate to that extent, and your UIN file gets created with Reserve Bank of India.
So next question is, if the ESOP issued prior to the Foreign Exchange Management Overseas Investment Regulations 2022, effective from 20th August 2022, do we require to file any form OPI for such prior period? If yes, then is there any penalty or delay filing fees?
Okay, so basically this form is not new as such. Only name is changed, or it is clubbed with form OPI. But earlier also there was form ESOP reporting for such arrangement, where the employees of Indian companies were issued shares of a foreign company. So the form was different. So in that case, RBI will consider this as a non-compliance. You have to complete the compliance of earlier form reporting, and by paying LSF, and obviously for the current the form OPI is required to be filed. So this is not a new requirement as such. Only the name has changed.
Okay, so next question is, can ECB loan interest and repayment schedule can be extended for further 4 years? In this case, how average maturity period is calculated?
Okay, good question.
Yeah.
So basically, average maturity period is a minimum requirement. Okay, if it says the minimum average maturity period should be 3 years, so repayment should not happen prior to that. But if you want to extend it beyond and extend by 4 years, and so in that case, your average maturity period is going from 3 years to 7 years, that RBI is happy on that. There's no problem. So this is possible. You can extend it.
So next question is there any other compliance for accepting the foreign investment other than getting such investment through authorized dealers?
So that's the primary requirement. If you look at the FEMA regulations, the mode of reporting and mode of realization, basically, the foreign direct investment should be received through normal banking channels only. So no other mechanism is possible. In a sense, there are other, like if there are payables, like let's say Indian entity has entered into technology transfer agreement, and under that Indian entity is supposed to pay technical know-how fees, and those fees are being now capitalized. So any import payables, those are capitalized. So these are non-cash transactions. So these are allowed. So against that, shares can be issued. But if you are actually getting a foreign currency, but then in that case, you have to realize through normal banking channel. You cannot receive it through your online payment gateways, so or this money transfer, all the other mechanisms. It has to be through authorized dealer, through normal banking channel.
Yes, sir. Sir, these were the questions.
Okay, thank you.
Yes. So can we conclude the session?
Yes, thanks a lot.
Okay, sir. First and foremost, I extend our heartfelt gratitude to our distinguished guest speaker, C.S. Sunil Nanal, for sharing your valuable insight and expertise with us today. Your knowledge and experience have provided us with a wealth of information and inspiration. We are truly honored to have had you. We are also grateful to our participants for your active engagement and enthusiasm. Your thoughtful questions and participation have enriched the discussion and made the session more valuable. Thank you so much.
Thank you.